The next crisis will not begin with panic. There will be no warning sirens, no sudden collapse, no clear moment when everything breaks. Because the system has learned how to fail quietly. Central banks are not calming markets. Institutions are not waiting. Corporations are not expanding. They are positioning. What looks like stability is preparation. What feels like resilience is control. And what appears normal is a system slowly shifting its weight. The crisis is not coming. It is already unfolding. The world does not prepare for crises through headlines or speeches. It prepares through quiet adjustments that rarely attract public attention. Long before panic reaches markets, signals appear in balance sheets, regulatory language, and institutional behavior. These signals are subtle by design. They are not meant to warn the public. They are meant to protect the system and those who understand how to read it. One of the earliest indicators is a shift in how risk is measured rather than how it is discussed. In recent years, regulatory frameworks across major economies have tightened capital requirements, adjusted stress test assumptions, and expanded liquidity buffers. These changes are often presented as routine technical updates, yet their timing and coordination reveal something deeper. Stress scenarios increasingly assume simultaneous shocks across credit markets, sovereign debt, and funding liquidity. This tells us not what regulators fear publicly, but what they quietly model behind closed doors. Central banks have also altered the structure of their emergency tools. New facilities are created without fanfare, often framed as precautionary or temporary. Lending windows are broadened. Eligible collateral definitions are expanded. Swap lines between major monetary authorities are maintained even during periods of apparent calm. These instruments are not built for optimism. They exist because policymakers expect dislocation to return, not as a possibility, but as a matter of timing. Economic statistics reinforce this interpretation. Despite official narratives of stabilization, volatility-adjusted risk metrics remain elevated. Credit spreads compress and widen more rapidly than in previous cycles. Market liquidity deteriorates faster during stress events, even when headline indices appear resilient. This divergence between surface stability and underlying fragility is not accidental. It reflects a system that functions only under continuous management. Another signal lies in the language of policy itself. Public communication emphasizes resilience, flexibility, and preparedness rather than growth or expansion. When authorities focus less on opportunity and more on containment, it suggests a defensive posture. This shift mirrors changes observed before previous systemic events, when institutions moved from encouraging participation to reinforcing safeguards. Institutional behavior provides even clearer evidence. Large financial entities reduce duration exposure quietly, rebalance toward cash-like instruments, and diversify funding sources. These moves rarely trigger media attention because they occur gradually. Yet aggregated data shows consistent positioning toward optionality rather than yield. In an environment where returns are secondary to survival, capital behaves conservatively long before narratives change. Global reserve management also sends signals. Central banks increase holdings of highly liquid assets while reducing exposure to instruments that depend on uninterrupted market functioning. This is not an ideological shift. It is a practical response to perceived systemic risk. When guardians of monetary stability prioritize immediacy over return, they are preparing for scenarios where access matters more than valuation. Corporate behavior aligns with this pattern. Large multinational firms increase inventory buffers, extend supply contracts, and secure redundant financing arrangements. Earnings calls reference uncertainty and flexibility rather than expansion. Capital expenditure focuses on resilience, automation, and control rather than scale. These decisions reduce short-term efficiency but increase survivability during disruption. Such trade-offs are only rational if disruption is expected. The labor market offers another quiet indicator. Firms retain talent even as growth slows, avoiding aggressive hiring while resisting deep cuts. This behavior reflects caution rather than confidence. Companies prepare to absorb shocks without destabilizing operations, a strategy informed by recent crises where human capital proved difficult to rebuild. Perhaps the most telling signal is what is not happening. In truly stable environments, leverage expands aggressively and risk premiums collapse. Today, leverage growth is selective and controlled. Speculation exists, but it is compartmentalized rather than systemic. Risk is allowed, but it is monitored. This suggests that authorities tolerate volatility as long as it remains contained, signaling an acceptance of turbulence rather than an expectation of calm. Media narratives often lag these realities. Public messaging prioritizes reassurance to maintain confidence, but confidence is a tool, not a belief. Those who manage the system understand that fear accelerates instability. Preparation, therefore, happens quietly, through mechanisms invisible to most participants. History supports this interpretation. Before previous crisis, the most important actions were taken not during collapse, but during the preceding period of apparent normality. Emergency frameworks were refined. Legal authorities were clarified. Institutions rehearsed responses internally. By the time markets reacted, the system was already positioned. What differentiates the current environment is scale. The global system is more interconnected, more leveraged, and more dependent on continuous liquidity than at any point in the past. This increases both fragility and the incentive to prepare early. The margin for error is smaller. Recovery windows are shorter. Intervention thresholds are lower. From an investor's perspective, these signals matter more than forecasts. Forecasts predict outcomes. Signals reveal behavior. When the largest actors in the system shift toward defense, they are not speculating. They are responding to information unavailable to the public or too complex to explain openly. The world is not preparing for a crisis because it is pessimistic. It is preparing because crises are no longer anomalies. They are mechanisms through which imbalances are resolved. The question is no longer whether disruption will occur, but how controlled it will be. And that is the most important signal of all. When preparation becomes permanent, instability becomes structural. The next crisis is not an interruption of the system. It is part of how the system now functions. Central banks rarely say what they are truly doing. Their public role is to stabilize expectations, not to reveal strategy. Words are chosen to calm, to delay reaction, to preserve confidence. Actions, however, tell a different story. When examined closely, the behavior of monetary authorities across the world reveals a pattern that is fundamentally defensive. They are not reassuring markets, they are positioning for impact. One of the clearest signs lies in the structure of balance sheets. After years of expansion, central banks publicly discussed normalization, tightening, and balance sheet reduction. Yet beneath this narrative, the architecture of liquidity support was preserved, and in some cases expanded. Emergency tools introduced during previous crises were not dismantled. They were institutionalized. Facilities once described as temporary became permanent options, quietly embedded into the monetary framework. This duality is not accidental. Central banks understand that withdrawing visible support signals confidence, while maintaining hidden support preserves control. By shrinking balance sheets gradually, while keeping emergency mechanisms ready, they attempt to balance perception and preparedness. The message to the public is stability. The message to insiders is readiness. Liquidity lines between major monetary authorities provide another signal. Swap agreements remain active even during periods of apparent calm. These arrangements allow central banks to provide foreign currency liquidity instantly, bypassing market mechanisms. Their continued existence suggests that authorities anticipate future disruptions in global funding markets. If confidence in cross-border dollar funding were absolute, such tools would be unnecessary. Their persistence reveals concern. Interest rate policy also reflects positioning rather than reassurance. Official guidance emphasizes data dependence and gradualism. Yet rate paths are adjusted frequently, sometimes abruptly, in response to stress. This flexibility is framed as prudence, but it also indicates that policymakers expect conditions to change rapidly. A system that requires constant recalibration is not stable. It is managed. Stress testing provides further insight. The assumptions embedded in recent regulatory exercises are increasingly severe. Scenarios include simultaneous declines across asset classes, sovereign stress, funding freezes, and operational disruptions. These are not hypothetical extremes. They reflect lived experience. By designing tests around compound shocks, authorities implicitly acknowledge that the next crisis is unlikely to be isolated. It will be systemic. Communication strategy reinforces this view. Central banks speak less about growth potential and more about resilience. The language shifts from expansion to containment. References to buffers, safeguards, and flexibility replace optimism. This is not accidental. It reflects a mindset shaped by repeated interventions. Policymakers no longer believe that cycles self-correct smoothly. They expect intervention to be necessary. Global economic data supports this interpretation. Despite headline growth figures, underlying fragility persists. Debt levels remain elevated across public and private sectors. Productivity growth is weak. Demographic pressures intensify fiscal strain. Monetary authorities are aware that their tools address symptoms rather than causes. Positioning, therefore, focuses on managing consequences rather than preventing imbalance. Another signal emerges in how central banks treat market volatility. In previous eras, volatility was viewed as a threat to stability. Today, it is tolerated within boundaries. Authorities intervene not to eliminate volatility, but to prevent disorder. This distinction matters. It suggests acceptance of turbulence as a feature rather than a failure of the system. Central banks aim to control the amplitude of shocks, not to avoid them. The evolution of policy frameworks further reveals strategic adaptation. Mandates expand beyond price stability to include financial stability, employment resilience, and systemic risk. This broadening increases discretion. With more objectives, authorities gain flexibility to justify intervention. This is positioning. It creates legal and political space to act decisively when needed. Reserve management decisions also reflect caution. Monetary authorities favor assets that maintain liquidity under stress, even at the cost of return. This preference contradicts narratives of confidence. If stability were assured, return optimization would dominate. Instead, immediacy and reliability take precedence. This is the logic of preparation, not optimism. International coordination adds another layer. Central banks consult more frequently, share information, and align responses. This coordination is framed as cooperation, but it also reflects recognition that crises transmit rapidly. Preparation, therefore, becomes collective. The system braces not for localized shocks, but for global contagion. The most telling evidence, however, lies in the asymmetry between words and deeds. Publicly, central banks emphasize strength and recovery. Privately, they expand toolkits, rehearse interventions, and monitor vulnerabilities. This asymmetry exists because confidence itself is a policy instrument. Panic is costly. Preparation must therefore be invisible. From an investor's perspective, this behavior is revealing. Central banks do not hedge against unlikely scenarios. They hedge against scenarios they consider plausible. When institutions with unparalleled access to data and expertise behave defensively, it signals expectation rather than fear. History reinforces this conclusion. Before previous systemic events, central banks positioned themselves quietly. They adjusted frameworks, clarified authority, and tested mechanisms. By the time crises became visible, responses were rapid because preparation had already occurred. The current environment shows similar characteristics, but on a larger scale. What differentiates the present moment is permanence. Preparation is no longer episodic, it is continuous. The assumption that stability will return fully has been replaced by an expectation of recurring stress. Central banks operate in a world where intervention is routine rather than exceptional. This mindset shapes policy choices. It favors flexibility over commitment, discretion over rules, and management over prediction. Markets interpret this as support, but support has limits. The objective is not to prevent crises, but to ensure they unfold in a controlled manner. Central banks are therefore not calming markets because they believe calm will last. They are positioning to respond when it does not. Their actions reveal an understanding that the next crisis is not an anomaly, it is a phase. And this is the critical insight. When the institutions responsible for stability behave as if instability is inevitable, they are not pessimistic, they are realistic. The system they manage requires constant intervention to function. Preparation is not a warning, it is an admission. The tools central banks are preparing for the next crisis differ fundamentally from those used in the past. This is not because previous instruments failed, but because their side effects became too visible. The next phase of intervention is designed to be quieter, more targeted, and structurally embedded. Instead of dramatic rescue operations, monetary authorities are building mechanisms that allow continuous influence without triggering panic. One of the most important shifts is the move from broad stimulus to selective control. In previous crises, liquidity was injected widely, flooding markets and stabilizing prices through sheer volume. That approach created unintended consequences: asset inflation, inequality, and long-term distortion of price discovery. Today, central banks are refining their ability to direct liquidity precisely where it is needed. Facilities are tailored to specific market segments, institutions, or instruments. This allows intervention without signaling systemic failure. Standing facilities illustrate this evolution. Rather than emergency tools activated only during crises, these mechanisms operate continuously in the background. They provide access to liquidity under predefined conditions, reducing stigma and delay. By normalizing access, central banks eliminate the psychological shock that previously accompanied emergency lending. Markets remain functional even under stress because support is perceived as routine rather than extraordinary. Collateral frameworks have also been redesigned. Eligible assets expand during stress automatically, without political debate or public announcement. This pre-authorization enables rapid response while preserving the appearance of market-driven outcomes. The system adapts instantly, absorbing pressure before it becomes visible. From the outside, markets appear resilient. Internally, they are supported continuously. Another critical development is the increased use of regulatory liquidity rather than monetary expansion. Instead of creating new money directly, authorities adjust capital and liquidity requirements temporarily. This frees balance sheet capacity without expanding headline monetary aggregates. The effect is similar to stimulus, but far less visible. Investors see stability without obvious intervention. This is deliberate. The goal is control without perception. Forward guidance has also changed in function. It is no longer primarily about shaping expectations of growth or inflation. It is about managing volatility. Language becomes ambiguous by design. Flexibility is emphasized over commitment. This ambiguity allows central banks to pivot quickly without appearing inconsistent. Markets are conditioned to expect change, reducing shock when it occurs. Another tool gaining importance is market microstructure control. Trading halts, circuit breakers, and volatility controls are refined and coordinated across asset classes. These mechanisms slow feedback loops during stress, preventing cascade effects. Rather than stopping declines, they regulate speed. This reflects a critical insight. Panic is not caused by losses, but by uncontrolled acceleration. By managing velocity, authorities manage perception. Currency markets receive particular attention. Swap lines, repo facilities, and cross-border coordination aim to prevent funding shortages that can destabilize entire systems. These tools are maintained continuously, even when unused. Their existence alone stabilizes expectations, but their persistence also reveals an assumption that currency stress will recur. Digital infrastructure plays an increasing role. Payment systems, settlement platforms, and real-time monitoring allow authorities to observe stress as it develops. Intervention thresholds are adjusted dynamically. This reduces reliance on lagging indicators and public data. Central banks act earlier, often before markets fully react. The crisis is managed before it becomes visible. The discussion around central bank digital currencies fits into this framework. While often presented as innovation or inclusion, these systems offer unprecedented precision in policy transmission. Liquidity can be targeted, timed, and conditioned. This is not about replacing cash. It is about enhancing control. In a crisis environment, such precision reduces the need for blunt, system-wide measures. International coordination further amplifies these capabilities. Shared frameworks and aligned tools allow synchronized response. This reduces arbitrage opportunities and limits spillover effects. Crises become global by default, and preparation reflects this reality. The system is designed to move together, minimizing fragmentation during stress. From a market perspective, this changes the nature of risk. Traditional tail events become less explosive but more frequent. Volatility is managed, not eliminated. Drawdowns occur, but they are engineered to remain within tolerable bounds. This creates an environment where losses are gradual rather than sudden, shifting risk from shock to erosion. For investors, this environment rewards anticipation rather than reaction. The visible crisis becomes less important than the positioning that precedes it. Those who understand the tools being built can infer the scenarios being prepared for. Central banks do not design instruments for unlikely outcomes. They design them for scenarios they consider probable. The most important implication is structural. When crisis management becomes permanent, markets stop functioning as discovery mechanisms and start operating as policy transmission channels. Prices still move, but within corridors shaped by authority. This does not eliminate risk, it redistributes it. Retail participants often misinterpret this as protection. In reality, it is management. The objective is not to preserve individual portfolios, but to maintain systemic continuity. Losses are acceptable as long as they are orderly. Failure is acceptable as long as it is contained. This reveals the true nature of preparation. Central banks are not building defenses to avoid crisis. They are building infrastructure to ensure that crisis unfolds under control. The difference is profound. Avoidance implies optimism. Control implies inevitability. In this framework, the next crisis is not an interruption. It is a process, a transition between states of the system. Monetary authorities are positioning not for collapse, but for transformation under stress. And this is why their actions matter more than their words. Words calm markets today. Tools shape outcomes tomorrow. Those who watch behavior rather than statements can see the direction clearly. The world is not being reassured. It is being prepared. Institutions never wait for confirmation. They move when signals align, not when narratives change. By the time a crisis becomes obvious to the public, positioning has already occurred. This is not a matter of superior intuition. It is a matter of incentives, access to information, and experience accumulated through repeated cycles. Institutions understand that survival depends not on predicting events, but on reacting earlier than others. One of the most consistent patterns preceding every major disruption is the quiet reallocation of capital. Large asset managers, banks, pension funds, and sovereign entities adjust exposure incrementally, avoiding actions that would attract attention or distort markets. These adjustments are rarely visible in headlines. They appear instead in aggregated flow data, balance sheet composition, and funding behavior. When examined together, they reveal intent. Liquidity preference is the first signal. Institutions increase holdings of instruments that can be converted into cash immediately under stress. This does not mean abandoning risk entirely. It means prioritizing optionality. Capital shifts toward assets with deep markets, predictable settlement, and minimal counterparty risk. Yield becomes secondary. Flexibility becomes paramount. This shift is gradual, often masked by market noise, but it is persistent. Another indicator lies in duration management. Long-term exposures are reduced quietly, replaced by shorter maturities or floating structures. This behavior reflects anticipation of volatility, rather than conviction about direction. Institutions do not attempt to time peaks. They minimize sensitivity. When uncertainty rises, the cost of being wrong increases. Reducing duration limits damage without requiring precise forecasts. Derivatives markets provide further insight. Hedging activity increases even when spot markets appear calm. Demand for protection rises before visible stress. This is not speculation. It is insurance. Institutions are willing to pay a premium to limit downside because they understand that protection becomes unavailable when it is most needed. The presence of hedging is itself a signal that risk is being reassessed. Funding behavior offers another clue. Institutions diversify sources of financing, extending maturities and securing committed lines. Reliance on short-term wholesale funding declines. This behavior reflects memory. Previous crises exposed the fragility of funding models dependent on continuous market access. Institutions that survived learned to prepare. Those lessons remain embedded in strategy. Corporate actions reinforce this pattern. Large firms delay discretionary investments, preserve cash, and renegotiate credit facilities. Share repurchase programs slow or pause quietly. Mergers become more selective. Public statements emphasize prudence and resilience rather than expansion. These choices reduce short-term performance metrics but enhance survivability. From an institutional perspective, this trade-off is rational. Global capital flows also shift in telling ways. Cross-border investment becomes more selective, favoring jurisdictions with stable legal frameworks and deep financial markets. Exposure to regions perceived as vulnerable declines gradually. These shifts rarely trigger immediate price changes, but they alter market structure over time. Liquidity concentrates where exit remains possible. The behavior of insiders further confirms this positioning. Executives and major shareholders reduce exposure subtly, often through diversification rather than outright sales. These actions attract little attention individually, but collectively they signal caution. Insiders possess intimate knowledge of operational and financial constraints. Their behavior reflects assessment rather than sentiment. Another critical signal emerges in how institutions treat correlation. In stable environments, diversification reduces risk. In stressed environments, correlations converge. Institutions aware of this dynamic reduce reliance on diversification alone. They seek assets that behave differently under extreme conditions. This search for true diversification intensifies before crises, revealing skepticism about surface stability. The role of regulation amplifies these behaviors. Institutions subject to stringent oversight must demonstrate resilience continuously. Stress scenarios embedded in regulatory frameworks influence real-world positioning. When regulators assume severe outcomes, institutions adjust accordingly. Compliance thus becomes a transmission channel for preparation. Media narratives often miss these dynamics because they focus on price movements rather than positioning. Prices react to events. Positioning anticipates them. Institutions operate on the latter. By the time prices move decisively, positioning is complete. Historical precedent supports this view. Before previous systemic disruptions, institutional players reduced exposure quietly. They did not predict collapse publicly. They prepared privately. When disruption occurred, they were positioned to absorb losses and redeploy capital. Those without preparation suffered disproportionate damage. What distinguishes the current environment is scale and sophistication. Data analytics, real-time reporting, and risk modeling allow institutions to detect stress earlier. Behavioral patterns are quantified. Early signals are amplified internally. Decision-making accelerates. Preparation begins sooner. This creates a structural asymmetry. Institutions act on signals invisible to most participants. Retail investors react to narratives that emerge later. This gap is not accidental. It is inherent to the system. Information flows unevenly, and incentives reward discretion. From a strategic perspective, this behavior reveals expectation rather than fear. Institutions do not de-risk because they believe collapse is imminent. They de-risk because the probability distribution has shifted. Tail outcomes carry greater weight. The system becomes less forgiving. Optionality becomes more valuable. This positioning also explains why markets can appear resilient even as risk increases. Institutional exits are gradual. Liquidity remains until it does not. Stability persists until it is withdrawn. The illusion holds as long as preparation remains incomplete among participants. The most important insight is behavioral. Institutions do not need consensus to act. They need alignment of signals. When liquidity preference rises, duration shortens, hedging increases, and funding stabilizes simultaneously, it indicates preparation. These signals are present long before crisis narratives form. The world often misunderstands institutional calm as confidence. In reality, it is discipline. Institutions understand that panic is costly. Preparation is silent by necessity. By the time concern becomes visible, it is already too late to position. This is why institutional behavior matters more than public statements. Statements manage perception. Behavior manages survival. When institutions move first, they reveal what they expect, not what they say. And in the current environment, their actions suggest a shared assumption. The next crisis does not need to be predicted precisely. It only needs to be expected. What separates institutions from the rest of the market is not foresight, but exit discipline. Institutions do not wait for confirmation, headlines, or panic. They exit risk through structure, timing, and sequencing. This process is rarely dramatic. It unfolds through a series of reallocations that, taken individually, appear insignificant. Taken together, they represent a strategic withdrawal long before stress becomes visible. The first stage of exit is internal repricing. Risk models are adjusted quietly. Assumptions about liquidity, correlation, and recovery time change. Assets that once appeared resilient are reclassified as vulnerable. This repricing does not immediately affect markets because it occurs inside balance sheets, but it changes behavior. New capital is no longer allocated to certain exposures. Existing positions are maintained only where exit remains feasible. The second stage is flow control. Institutions reduce net inflows into risk assets without triggering alarms. Marketing emphasis shifts. Allocation committees favor neutral or defensive positioning. Mandates become more flexible, allowing temporary deviation from benchmarks. This flexibility is crucial. Benchmarks reflect the past. Institutions preparing for crisis cannot afford to be constrained by them. Simultaneously, institutions begin trimming exposure through natural turnover. Positions are reduced as instruments mature, contracts expire, or rebalancing occurs. There are no mass liquidations. Liquidity is preserved. Markets remain orderly. To outside observers, nothing appears wrong. Prices continue to move within normal ranges. Derivatives play a critical role in this phase. Instead of selling underlying assets aggressively, institutions hedge exposure synthetically. This limits downside while preserving optionality. It also avoids signaling stress. Protection is acquired early, when it is affordable and available. As volatility rises, hedging costs increase sharply. Institutions understand this asymmetry. They act before it becomes visible. Credit markets offer some of the clearest evidence of early exit. Institutions reduce exposure to lower quality credit first, even when spreads remain tight. They favor issuers with stable funding and strong balance sheets. This rotation occurs quietly, reflected only in aggregate issuance data and investor composition. When credit conditions tighten later, institutions are already positioned defensively. Another key mechanism is collateral management. Institutions improve the quality and liquidity of collateral held against obligations. This reduces vulnerability to margin calls during stress. It is a subtle but powerful form of preparation. When volatility spikes, those with high-quality collateral survive. Those without are forced sellers. The sequencing of exit matters. Institutions do not abandon all risk simultaneously. They exit assets with poor liquidity first, retaining exposure to instruments that can be sold later if needed. This preserves optionality and avoids market disruption. Retail participants often do the opposite, holding illiquid assets until exits are impossible. As preparation progresses, institutions also adjust governance. Decision-making authority is clarified. Emergency procedures are rehearsed. Risk committees meet more frequently. Thresholds for action are lowered. This organizational readiness ensures rapid response when conditions deteriorate. It is invisible externally, but decisive internally. Public data eventually reflects these shifts, but with delay. Asset prices may remain elevated. Volatility may stay low. Analysts often interpret this as confirmation that fears were unfounded. In reality, it reflects the success of quiet exit. Markets remain stable precisely because exits are controlled. The final stage of institutional exit occurs when liquidity begins to thin. At this point, institutions accelerate repositioning, but still avoid panic. They sell into strength, not weakness. They redeploy capital selectively, often into assets that benefit from volatility or stress. By the time retail participants recognize danger, liquidity has already been withdrawn. This dynamic explains why crises often appear sudden. The visible collapse occurs only after the exit is complete. What looks like a rapid shift is the culmination of months or years of preparation. Institutions are not reacting to the events. They are concluding a process. Those left exposed are typically participants constrained by structure or psychology. Passive investors tied to benchmarks cannot exit without tracking error. Retail investors react to narratives rather than signals. Smaller institutions lack flexibility or access to hedging. These actors become the marginal sellers when stress intensifies. This asymmetry is structural. It is not the result of manipulation, but of incentives and design. Institutions are rewarded for survival and capital preservation. Others are rewarded for participation and optimism. When conditions change, these incentives diverge sharply. The most important implication is that markets do not fail when fear appears. They fail when liquidity disappears. Liquidity disappears not because everyone sells at once, but because those who provide it have already left. Institutions understand this. Their preparation is focused on ensuring they are not the last ones standing. In the current environment, this process is more advanced than many realize. Institutional behavior reflects acceptance that cycles are shorter, recoveries are managed, and shocks are recurrent. The objective is not to outperform during expansion, but to remain solvent and flexible during transition. This is why institutions often underperform near market peaks and outperform after crises. They sacrifice upside for survivability. This trade-off appears conservative in calm periods and brilliant during stress. It is not about timing tops. It is about avoiding forced decisions. For observers who know where to look, the signals are clear. Rising demand for liquidity, early hedging, duration reduction, collateral improvement, and governance tightening all indicate preparation. These behaviors precede every major disruption. They are present now. The conclusion is uncomfortable but unavoidable. When institutions exit quietly, they are not speculating. They are responding to probability. The system they operate in rewards early movement and punishes delay. The next crisis will not be announced, it will be revealed. And by the time it is visible, the positioning will already be done. Markets are no longer designed primarily for growth. They are designed for shock absorption. This is the defining shift of the modern financial system, and it explains why markets behave in ways that appear contradictory to traditional logic. Prices rise without enthusiasm, fall without panic, and recover without conviction. This is not confusion, it is engineering. After repeated crises, policymakers, regulators, and exchanges reached a shared conclusion. Uncontrolled market reactions are more dangerous than economic downturns themselves. The objective therefore shifted from maximizing efficiency to managing instability. Markets were quietly rewired to slow down, contain, and distribute stress over time. Stability no longer means expansion, it means controlled movement. One of the clearest manifestations of this shift is the proliferation of automatic stabilizers embedded directly into market infrastructure. Circuit breakers, volatility pauses, and dynamic margin requirements are no longer emergency tools. They are permanent features. These mechanisms do not prevent losses, they regulate speed. When prices move too quickly, trading slows or stops. This interrupts feedback loops that previously transformed fear into collapse. The result is a market that can fall, but not freely. Liquidity provision has also been redesigned. Central banks and primary dealers operate as backstops rather than drivers. They do not push markets upward aggressively. They stand ready to intervene when disorder appears. This posture creates a floor without promising upside. Investors sense support, but not opportunity. The psychological effect is profound. Risk-taking becomes cautious, incremental, and reversible. Regulatory changes reinforce this behavior. Capital requirements, leverage ratios, and liquidity coverage rules constrain how much risk institutions can take during expansions. These constraints reduce upside, but increase resilience. Banks no longer amplify cycles as they once did. Their balance sheets are structured to survive stress rather than to maximize return. This transformation limits credit-driven booms and dampens busts, producing slower but more controlled cycles. Market microstructure reflects similar priorities. High-frequency trading is monitored and constrained. Order-to-trade ratios, minimum resting times, and transparency requirements reduce the probability of flash events. Exchanges coordinate halts across asset classes to prevent contagion. These measures reduce efficiency but enhance predictability. Markets become less responsive to information and more resistant to panic. Economic data illustrates the consequences. Volatility spikes are shorter and more frequent, but less extreme. Drawdowns unfold over weeks rather than days. Recoveries are managed rather than organic. Asset correlations increase during stress, reflecting centralized intervention rather than decentralized discovery. Traditional indicators lose explanatory power because behavior is shaped by policy architecture rather than fundamentals alone. Derivatives markets play a critical role in this new design. They allow risk to be transferred, sliced, and redistributed without forcing immediate liquidation of underlying assets. This delays visible stress. Losses are absorbed through margins, collateral adjustments, and rollovers. The system bleeds slowly instead of collapsing suddenly. This is not accidental, it is intentional. The language of policymakers confirms this orientation. References to smooth functioning, orderly markets, and financial stability dominate communication. Growth is mentioned cautiously. Inflation is framed as a risk to stability rather than an opportunity for adjustment. The emphasis is on continuity. Markets are expected to function, not to thrive. From an investor's perspective, this creates a paradox. Risk is omnipresent, but crises feel muted until they are not. Signals that once preceded sharp corrections now lead to prolonged stagnation. Valuations remain elevated, not because optimism is high, but because exits are constrained and alternatives are limited. Capital stays invested because withdrawal is gradual and costly. Another critical element of market rewiring is the redistribution of volatility. Instead of concentrating losses in a single event, stress is spread across time, sectors, and participants. Some assets decline early and slowly. Others lag and then adjust abruptly. This uneven adjustment confuses participants who expect synchronized moves. But it reflects deliberate design. The system aims to avoid focal points of failure. Retail participation is affected significantly. Individual investors experience markets that appear safer, yet less rewarding. Sharp crashes are rarer, but drawdowns linger. Confidence erodes gradually rather than collapsing suddenly. This slow erosion discourages speculation without triggering panic. It is a form of behavioral regulation achieved through structure rather than messaging. Institutional investors adapt accordingly. Strategies emphasize relative value, carry, and volatility harvesting rather than directional conviction. Returns are generated through persistence, not timing. This favors scale, access, and patience. Smaller participants struggle to adapt, interpreting muted signals as stability when they are in fact compression. Global coordination reinforces this architecture. Central banks, regulators, and exchanges share frameworks and data. Stress responses are aligned. This reduces arbitrage and limits the ability of shocks to migrate unchecked. Markets across regions behave more similarly under stress, reflecting synchronized management rather than independent reaction. The cost of this approach is visible in long-term growth metrics. Productivity gains slow. Capital misallocation persists longer. Inefficient firms survive through support mechanisms. Creative destruction is delayed. The economy becomes more stable, but less dynamic. This trade-off is accepted consciously. Stability is prioritized over renewal. Historical comparison highlights the shift. Previous eras tolerated volatility as the price of progress. Failures were rapid and decisive. Today, failure is managed. Resolution is gradual. The system absorbs shock through time rather than confrontation. This reduces social and political backlash, but accumulates structural inefficiencies. For analysts focused on fundamentals alone, this environment is perplexing. Traditional signals fail. Valuation metrics lose predictive power. Yet the system behaves rationally within its new constraints. It is optimized for continuity, not optimization. This rewiring explains why markets often appear disconnected from economic reality. Prices reflect policy architecture as much as underlying conditions. Intervention is not always visible, but it is always anticipated. Anticipation itself alters behavior. Markets move cautiously because participants know that extremes will be managed. The most important implication is temporal. Crises no longer resolve quickly. They stretch. Adjustment occurs through prolonged stagnation, rolling stress, and gradual repricing. This is less dramatic, but more exhausting. The system survives, but at the cost of momentum. This is not a temporary phase. It is the operating model. Markets are no longer arenas of spontaneous discovery. They are managed environments designed to withstand repeated shocks. Stability is achieved not by preventing stress, but by controlling its expression. And this is why preparation matters more than prediction. In a system engineered to absorb shocks slowly, the danger lies not in sudden collapse, but in extended erosion. Those who understand this design adjust expectations accordingly. The next crisis will not announce itself through chaos. It will reveal itself through fatigue. Controlled stability creates the illusion of safety, but it also concentrates pressure beneath the surface. When markets are engineered to absorb shocks gradually, stress does not disappear. It accumulates. The system trades visibility for duration. This trade-off reduces the probability of sudden collapse, but it increases the certainty of prolonged strain. Over time, this strain reshapes behavior, incentives, and outcomes in ways that ultimately force a reckoning. One of the first consequences of managed stability is the distortion of risk pricing. When downside is softened repeatedly, markets lose their ability to discriminate efficiently between strong and weak participants. Risk premiums compress beyond what fundamentals justify. Capital flows toward assets that appear protected rather than productive. This misallocation persists longer than in previous cycles because correction mechanisms are delayed. The system becomes quieter but less accurate. Economic statistics reveal this distortion clearly. Productivity growth weakens even as asset prices remain elevated. Investment favors financial engineering over real expansion. Debt accumulates because the cost of capital remains artificially low relative to risk. Firms that would not survive in a fully competitive environment continue operating, supported by liquidity and regulatory tolerance. This is stability at the expense of renewal. Over time, the gap between market performance and economic reality widens. Wages stagnate while valuations rise. Corporate margins depend increasingly on financial conditions rather than operational improvement. Growth becomes uneven and fragile. Policymakers respond with additional measures to preserve continuity, reinforcing the cycle. Each intervention solves an immediate problem while amplifying long-term imbalance. The accumulation of leverage is a critical byproduct of this environment. When volatility is contained, leverage appears manageable. Funding costs remain low. Balance sheets expand gradually. This expansion does not trigger alarms because it unfolds within regulated boundaries. Yet leverage amplifies sensitivity. Small changes in conditions produce outsized effects. The system becomes more brittle even as it appears calm. Another consequence is behavioral fatigue. Prolonged periods of managed stress erode confidence slowly. Participants do not panic, they disengage. Risk appetite declines not abruptly, but persistently. Capital becomes cautious, defensive, and short-term oriented. Innovation slows. Long-term projects are deferred. This erosion is difficult to reverse because it reflects experience rather than sentiment. Markets also become increasingly dependent on policy signaling. Expectations adjust continuously to guidance, interpretation, and speculation about intervention. This reliance reduces autonomy. Prices respond less to fundamentals and more to perceived support. When guidance becomes ambiguous or credibility weakens, volatility increases disproportionately. The system reacts not to events, but to uncertainty about control. International dynamics exacerbate these pressures. As major economies adopt similar stabilization frameworks, global cycles synchronize. Diversification benefits diminish. Stress propagates more evenly across regions. Local shocks become global adjustments. Coordination reduces volatility initially, but it also concentrates systemic risk. When all markets are managed similarly, failure modes converge. Financial innovation adapts to this reality. Products are designed to perform under managed volatility, exploiting predictable patterns. Strategies harvest small inefficiencies created by intervention. Returns become incremental and fragile. When patterns break, losses accumulate rapidly. This creates a system optimized for normal conditions but vulnerable to regime shifts. Regulatory frameworks unintentionally reinforce this vulnerability. Rules designed to ensure resilience under known scenarios encourage similar positioning across institutions. Homogeneity increases. When stress exceeds modeled assumptions, simultaneous adjustment amplifies impacts. The system is resilient to expected shocks, but exposed to surprises. The most dangerous aspect of managed stability is complacency at the margins. Participants mistake absence of chaos for absence of risk. Early warning signs are ignored because immediate consequences are muted. When adjustment finally occurs, it is resisted because it threatens the narrative of control. Policymakers intervene further, delaying resolution. The cycle continues until intervention loses effectiveness or credibility. Historical patterns suggest that such systems do not fail suddenly. They reach inflection points. Stress accumulates until marginal intervention no longer stabilizes behavior. At that point, adjustment accelerates despite controls. Markets move not because mechanisms fail, but because participants no longer believe in them. Confidence, once lost, cannot be engineered. This is the paradox of controlled markets. The more stability is managed, the more essential trust becomes. And trust depends on outcomes aligning with expectations. When expectations are repeatedly deferred rather than resolved, trust erodes. Economic news often captures this erosion indirectly. Slower growth forecasts, rising default risk despite low rates, persistent inflation alongside subdued demand. Each signal alone appears manageable. Together, they indicate structural strain. The system functions, but at diminishing efficiency. For investors, this environment demands a different mindset. Success is no longer defined by timing peaks or bottoms, but by endurance. Capital preservation, optionality, and adaptability matter more than maximizing returns. Strategies must assume prolonged adjustment rather than quick recovery. The transition point is difficult to predict because it is psychological as much as financial. It occurs when enough participants decide that waiting is no longer rational. This decision does not require panic. It requires exhaustion. When patience runs out, even controlled systems move. The current market architecture delays this moment, but it cannot eliminate it. Control can slow adjustment, but it cannot resolve fundamental imbalance. Eventually, the cost of delay exceeds the cost of change. This is why preparation continues, even as markets appear calm. Those designing the system understand its limits. Managed stability buys time. It does not buy resolution. The next crisis will not be defined by chaos, but by loss of confidence in management itself. When intervention ceases to reassure, mechanisms designed to absorb shock become constraints that accelerate it. In that moment, markets will not collapse violently. They will transition decisively. And the transition will reveal what controlled stability was always meant to do: not prevent crisis, but determine who survives it. The final misunderstanding about the next crisis is the belief that it will arrive as an external shock. It will not. It is already embedded in the structure of the system itself. What the world is preparing for is not collapse, but transition. A controlled reconfiguration of capital, power, and expectations that unfolds gradually, unevenly, and often invisibly to those waiting for a single defining moment. Modern crises no longer function as resets. They function as reallocations. Capital does not disappear, it moves. Risk is not eliminated, it is reassigned. Losses are not evenly distributed. They are concentrated where adaptation is slowest. This is why preparation focuses less on prevention and more on positioning. Those who understand this do not ask when the crisis will happen. They ask who will absorb the cost. Economic data already reflects this transition. Growth persists, but it is shallow and uneven. Productivity gains fail to translate into broad prosperity. Asset prices remain elevated relative to underlying economic output. Debt continues to expand across sovereign, corporate, and household balance sheets. None of these trends indicate imminent collapse. They indicate compression. A system operating beyond its natural limits, sustained through intervention and expectation management. Global news reinforces this pattern. Policymakers speak less about expansion and more about resilience. Corporate guidance emphasizes flexibility over ambition. Investment shifts toward defensive sectors, infrastructure and control rather than innovation and scale. Capital expenditure decisions prioritize durability under stress rather than return under growth. These are not the behaviors of a system expecting recovery. They are the behaviors of a system managing transition. The role of the crisis in this environment is functional. It provides justification for reallocation that would otherwise face resistance. It accelerates trends already underway. It allows institutions to reset terms, restructure obligations, and redefine priorities under the cover of necessity. What appears as disruption is often consolidation. What appears as loss is often transfer. This is why the next crisis will feel different. There will be no singular trigger, no universal panic. Instead, there will be a series of adjustments that gradually reshape outcomes. Some sectors will weaken early. Others will remain artificially strong. Credit will tighten selectively. Liquidity will persist where it serves stability and withdraw where it threatens control. The process will be uneven by design. From an investor's perspective, this environment rewards those who understand sequencing. The question is not whether markets will decline, but when and where pressure will be allowed to surface. Managed systems do not fail uniformly. They fracture along predefined fault lines. Those fault lines are visible to those who study incentives rather than narratives. Institutions preparing for this transition focus on three priorities. First, survivability. Balance sheets are structured to endure prolonged stress rather than short shocks. Second, optionality. Capital is positioned where it can be redeployed quickly when conditions change. Third, access. Control over liquidity, information, and infrastructure matters more than raw return. This explains why returns in the coming period are likely to be asymmetrical. Passive exposure will underperform. Broad diversification will provide limited protection. Value will concentrate in areas aligned with system priorities: stability, infrastructure, control, data, energy security, and financial plumbing. Growth will exist, but it will be narrow and policy dependent. The social dimension of this transition cannot be ignored. Prolonged managed stress erodes confidence gradually. Households adapt by reducing consumption, increasing precautionary savings, and lowering expectations. Labor markets remain tight but fragile. Real incomes stagnate. Political pressure builds, not through collapse, but through fatigue. This environment is stable until it is not, because patience is finite. Governments understand this dynamic. Their challenge is not economic collapse, but legitimacy under constraint. Policy, therefore, balances containment with appearance. Support is provided selectively. Pain is distributed unevenly. Narratives emphasize external forces to deflect accountability. The crisis becomes a story of necessity rather than choice. Internationally, the transition reinforces fragmentation. Coordination persists where required to prevent systemic failure, but competition intensifies elsewhere. Capital aligns with jurisdictional security. Neutrality becomes expensive. Economic blocks solidify. This reduces efficiency, but increases predictability within controlled environments. Global integration recedes not because it failed, but because it became unmanageable. The most dangerous mistake is to interpret this environment as temporary. It is not. The mechanisms being built are permanent. Crisis management has become a standing function of the system. Intervention is continuous. Adjustment is slow. Resolution is deferred. This does not eliminate risk. It changes its form. For those operating within this system, the implication is clear. Strategy must replace optimism. Preparation must replace prediction. Exposure must be deliberate. Waiting for clarity is equivalent to waiting too long. The system rewards those who move before necessity becomes obvious. The next crisis will not announce itself with panic. It will unfold through policy shifts, market rewiring, and gradual repricing. By the time it is widely acknowledged, the redistribution will already be advanced. Those unprepared will not fail suddenly. They will be left behind quietly. This is the defining feature of the modern financial order. Power does not reveal itself through collapse. It reveals itself through continuity under pressure. The system survives by changing who bears the cost. The crisis is not the event, it is the mechanism. And the world is not waiting for it. It is already adjusting around it. Those who understand this are not afraid. They are positioned. Those who do not will ask later why nothing felt wrong until everything was. The next crisis will not be remembered for what collapsed. It will be remembered for who was ready. Capital will not vanish. It will move. Risk will not disappear. It will be transferred. Those who understand how the system works do not wait for clarity. They position before necessity becomes obvious. This is not a story about fear. It is a story about preparation. Because in the modern financial system, the greatest danger is not collapse. It is realizing too late that the transition already happened. Stay ahead. Stay analytical. Shadow Rewind continues.